Let's move on. Let me now welcome on board K. Paul Thomas, the MD and CEO at ESAF SFB, joining in on the show right now. Mr. Thomas, hi, great to have you on the show. First, let's just look at your numbers right now, and I can see that your PPOP growth was healthy, led by your other income. But do you think that such elevated numbers are going to sustain, or do you think there was a one-off this time?
No, that our other income started. We have started more partnerships, and so our other income started increasing, growing, and we hope that that will going to stay. It is not an one of our events. So this is going to continue.
Right. And, if we look at the other expenses too on that front, you saw a sharp uptick in the employee cost. The cost to income also is inched up. Is it mainly due to this branch expansion, or how are you expecting this to move in FY25?
Yeah, last financial year we have opened 53 new branches, and previous year also we have opened 50 branches. All those branches staffing has been done during the current last financial 23-24, and number of staff also got increased because we have started new verticals, added more people on the retail asset verticals like mortgage, mobility, and MSME. And agri vertical also, we have added more people. We have started 6 credit hubs during the last financial year. Zonal office was opened in Delhi. So all this added more number of staff, and the increase in staff cost is due to all these factors.
All right. What is the outlook then when we look at the provisions? Because that has gone sharply higher. It's impacted your profitability. So what's the take to make sure that down the line your provisions will not be that elevated, or will it continue to remain elevated?
Yeah, we have given an additional provision of 82 crores this quarter. That has impacted our profitability also. But so we have the slippages we were able to control compared to the previous quarter. So we will continue to have this elevated provision for 1 or 2 quarters to manage the current gross NPAs we are having.
I'm talking about the gross NPAs only. When you're looking at it also, slight bit of a deterioration in the asset quality we're seeing during the quarter. Last quarter, obviously there was, I think, a one-off that was there, one specific event in geographies like Kerala. But why was the stress building in this quarter then?
No, that is still continuing. So we have discussed last quarter when we discussed about the results. So we have seen every year a trolling ban happens across the coastal areas, and we have large number of customers in the west coast area. So that's still because of the climate change issues, that stress still continue in those geographies, and some of the geographies due to the flood in Tamil Nadu, that has still not completely overcome. So it may take 1 or 2 quarters to completely come out of the stress.
All right, and let's come to your net interest margins for the quarter. This time around, the cost of funds have gone higher. The yield on advances went down. Together, this has impacted your net interest margin. So that's at around 10%. Where do you see it for FY25?
So we've also proposed 10% net interest margins in our previous interactions also. We hope that that will continue to be around that 10%. And on the fund cost, there is only a marginal increase, 10 basis point only increase. So we are not expecting that to increase further. We have got a very good, strong retail deposit base, and that will continue to support. Almost 92% of our total deposits are from retail deposits. So we will be able to maintain that cost of funding at that level. And as we continue to grow in our retail assets, so some of the assets we are building at a lower rate, so that was impacted on the margins on the asset side. But overall, we were able to maintain 10.4% NIM. So we will continue to maintain that, and the recovery also will help in maintaining this NIM.
Just want to understand one more thing is just in terms of the mix, how do we see that changing going forward from microloans, retail loans, MSMEs and agriculture? We've seen retail loans clearly has seen a sharp increase versus last year in terms of the mix. So is that something that you're focusing on, or what is the focus going to be?
Yeah, from the beginning, we were focusing to reduce the concentration on microfinance loans. So we have been strategically working on it by growing our retail asset book. So year-on-year basis, we were able to bring down the microfinance concentration to 4 to 5%. So last year, microfinance was 74%. This year, we brought down that to 70%. So the absolute value of microfinance book has have grown, but we have grown our gold loan book to around 12%. Agri book has grown around 6%. So the mortgage book started growing, MSME book started growing, mobility book started growing. So all this really helped us to manage the right mix. So we will continue to focus on building the retail asset book, specifically on mortgage and agricultural and gold loan.
To have you on board. Thank you for taking time out and joining in and giving us a view on all your financial projections. Time to slip into a...
If you like this video, then like, share and subscribe to ET Now.